What's up, traders? In this video, we will be discussing trade management techniques. So stay tuned. Now, if you've been finding it a bit tricky navigating the financial markets using smart money concepts and would like some guidance in your trading, then I suggest checking out my Patreon memberships. Link can be found in the description below. Now, I believe that it's very important for every trader to have a clearly defined trade management approach outlined in their trading plan. The difference between a winning trade or a losing trade, a winning month or a losing month, can often be decided by the way you manage a position. Now, much like everything else in trading, it's important for you to find an approach that resonates with your personality, that resonates with the way in which you want to trade the markets. And so today, I want us to look at a few of those techniques. Now, the first trade management technique is very simple and very straightforward. It involves a set and forget or an enter and forget approach. With this particular technique, after you've identified your high value area where you would like to execute your position, you would either place a limit order directly on the zone, or as price action comes in to interact with your area, you would execute your position at market using a market execution. And then once you have entered the trade, you literally allow it to run until either your stop loss is hit or your TP is hit. You don't do anything else before either one of these levels are hit. Now, the second trade management technique is going to involve trailing your stops in order to lock in profits. With this style of trade management, you still are going to have a clearly defined stop loss and you're still going to have a clearly defined take profit target. However, the management of your position is going to be a lot more dynamic and is going to be way less passive than the set and forget or the enter and forget approach. Now, you're still going to be executing the trade in the same way in terms of your entry, but you're going to be keeping a much closer eye on how market structure develops after you have entered your trade. And essentially what you want to be doing here is every time price action creates a new higher high when you're in a buying trade or a new lower low when you're in a selling trade, you then want to use that as an opportunity to move your stop loss higher and higher as price action trades in your direction. So initially what you want to do when price action has created that new higher high, when you have seen that new break of structure, initially you're going to be going ahead and moving your stop loss to break even. By doing this, you essentially become risk-free on the position. And then it's simply a case of every time price action creates a new higher high and you've seen a break of structure, you want to then go ahead and trail your stop higher and higher to these new structural higher lows in here. So after this break of structure takes place and price action creates this new high, you want to move your stop loss to either the initial higher low or the most recent higher low in here. You can play around with it and you can see how you can define this particular trailing stop method. So new break of structure occurs, you trail your stop. Another break of structure occurs and then you simply trail your stop again. Once another break of structure occurs, you trail your stop again. And all the while, as price action is trading higher and higher, you still have that overall take profit target that you want to be aiming for. And you're quite literally just following along with market structure and trailing your stops as price action trades towards your TP target. Now, one of the main reasons why you'd want to incorporate this particular trade management style is because there is obviously no guarantee that price action after entering your position will reach your full TP target. Remember, as price action is trading higher, it's going to be interacting with previous areas of supply and demand, previous areas of imbalance or fair value gaps. And at any one of these points, price action can reverse to come back and either retest your initial entry or to come in and violate this particular low to give you a brand new phase of the market. So by using this trailing stop technique, you're essentially guarding yourself against the possibility that price action to roll over and take you out. Now, the third trade management technique is going to be another dynamic trade management style, and it's going to involve management at decision points. Now, after you have performed your analysis, after you've identified the high value area where you want to get involved, and after you have outlined your take profit target, you are going to also have these key decision points that price action is going to face as it trades towards your TP target. And these decision points are going to be previous highs or lows, session highs, session lows. It's going to be unmitigated supply and demand zones. And it's also going to be imbalances or fair value gaps. Essentially, they are going to be areas on the market that have been left behind during this pullback phase as price action comes in to interact with your zone. So you're going to have a decision point in here, in here, in here, as well as in here. As you can see, these are previous highs of the market. There's likely to be areas of supply at these areas as well. And there's also likely to be some imbalance or some fair value gaps that sit just below those particular supply zones. So these are now regarded as decision points. And the reason they're regarded as decision points is if we look at this first decision point in here, right after you get tapped into the trade, if you have a supply zone in here, there is the possibility that as price action comes in and interacts with the zone, that it can roll over to continue with what is this established bearish trend to then go ahead and violate this low. So this is an area on the chart where your particular trade idea could break down. This is now an area on the chart where you can make a decision about the particular position that you have open. Now, what are some of the decisions that you can make at these decision points? The first one is you can go ahead and you can protect your position. What this entails is as price action comes in to interact with this previous supply zone in here, you can go ahead and you can move your stop to break even. The reason you want to do this is because there is that possibility that price action respects the supply area and rolls over. So instead of taking a full 1% or 2% loss, you essentially just take a break even trade in here if price action rolls over. Now, understand as well that if you move your stop loss to break even, there is also the possibility that price action can come in. It can retest the area where you got involved before then continuing in the initial trade direction that you had identified. So you do run the risk with this particular trade management technique of missing out on a couple of really good trades because of the fact that you'd like to protect your position a little bit more. Now, the second decision that you can make at these decision points is you can go ahead and you can take off partials at these areas. As price action comes in to interact with that first decision point, you can go ahead and take off, let's say 0.25% of your position, or you can take off 50% of your position, etc., etc. The reason you want to do this is again because there is that possibility that as price action interacts with those decision points, that it can roll over and potentially take you out of the trade. At the second decision point, you can take off another 0.25% of your position. And then as price action continues to trade higher, you can continue taking partials as a way of securing profits during this move. And then the third decision that you can make at these decision points is you can simply go ahead and you can do nothing. Let's just say, for example, that at the first decision point in here, you have either moved your stops to break even or you have taken off a few partials. By the time price action comes in to interact with the second decision point in here, you don't need to do anything, right? You can tell yourself that I'm happy with the partials that I was able to secure in here, I'm happy with the fact that I've moved my stop to break even. So after that initial management at the first decision point, you can simply allow this particular trade to play out to see whether or not it reaches your full TP. There is no obligation to always make a decision at these key decision points. And this brings me on nicely to something very important that you need to understand when it comes to implementing these trade management techniques. Number one, not all trade management techniques will work for every scenario. Let's just say, for example, that you're looking to get involved in this area in here, but instead of having your full TP all the way up here at this perceived weak high, let's just say that you have your take profit target placed at this high in here, right? Now, this is going to be the first decision point of this particular trade setup. So with this trade in here, you won't really have the opportunity to trail your stops to lock in profits, because based on the trade potential that you've outlined, realistically, you aren't going to have that many structure breaks that create new structural highs where you can move your stops to lock in some of those profits. So in this scenario, trade management style number 2 might not be applicable, or you might not get the opportunity to utilize it. In the same way, because of the fact that your take profit target has been placed at what is the first decision point, essentially, instead of looking to protect your position or instead of looking to take partials, you can literally just look to either wait for full TP to hit, or you can look to close out the full position in here if you see price action generating information that suggests your full TP may not be hit. All right. So very important that you understand not all techniques will work for every scenario, but it's important that you have a trade management approach outlined in the first place. And then secondly, these particular techniques can be combined to create a tailor-made approach. Now, at the end of the video, I want us to look at a trade opportunity that presented itself on GBP USD this past week. And I want to show you guys how these different trade management techniques could have been applied in this scenario. So if we look at the pair here on the 4-hour chart, we see we have this recent break to the upside. Price action is currently experiencing this pullback phase. We have this 4-hour demand zone that we anticipate this pullback phase to reach, mitigate before potentially rolling over to target this weak high in here. But by identifying this 4-hour demand zone, we've essentially given ourselves a short-term directional bias for where price action currently sits in here. And that short-term directional bias is going to be essentially bearish. And if we drop down to our 1-hour time frame in here, we see that price action has swept the previous day's high in here. And after sweeping that high, it prints this new 1-hour supply zone. The 1-hour supply zone gives us this little internal change of character in here. And now what we have is we have a potential counter trend short opportunity trading from this 1-hour supply in here down towards potentially this 4-hour demand down here. So now we have our trade idea. Now we have our stop loss and our take profit outlined. What we then see is price action comes back in to retest that 1-hour supply zone, and then it triggers us into the trade. And then after being tapped into the trade, price action rolls over to hit full TP. Now I want us to drop down to the 15-minute time frame very quickly so that we can outline the different trade management techniques that we could have applied to this particular trading opportunity. The first one is obviously the set and forget, or the enter and forget technique. After we get triggered into the trade, we do nothing. We allow price action to trade lower until either our stop loss is hit or our take profit is hit, which is what it did on this occasion. With the second trade management technique, which involves trailing our stops, after we get tapped into the trade in here, we get this break of structure that takes place here. After price action violates this particular low in here, we then have the opportunity to move our stop to break even because of that initial break of structure. And by moving our stop to break even at this point, we obviously then become risk-free on that position, and we then follow price action along. After this break, price action obviously generates this internal high in here, and as it trades down lower, you can see that we have this little pullback in here. So once that little pullback occurs, and as price action starts consolidating in this area, this is going to be an internal high that you can then trail your stop down towards because of the fact that you're seeing price action slowing down in this area as it interacts with that 4-hour zone. So you're using structure to trail your stops into profit. And then on this occasion, you can see that after we get our next break of structure to the downside, we are essentially already at our full TP target. So there wouldn't really be a need to trail your stops even further, although you can, right? You can be a lot more aggressive once price action starts interacting with this 4-hour demand zone. So that's our second trade management style. And then the last trade management technique that we have available to us is obviously the management at our decision points. Remember, our decision points are previous highs, previous lows, fair value gaps, imbalances, or any unmitigated supply and demand zones. And on this occasion, we have two decision points present. We have this 15-minute demand in here, and then we also have this previous low in here. As price action comes in to interact with this 15-minute demand zone, number one, we can look to protect our position by moving our stops to break even, or what we can do is we can go ahead and we can close out some partials in this position, 0.25% of our initial 1% or 50%, whatever floats your boat, whatever tickles your fancy. Or we can do a combination of the two, right? We can close out partials in here and we can move our stops to break even. We can also see that we had this large candle in here, which I believe was news driven, which not only wicks below this supply zone, but it also takes out this previous low in here. So at the time when seeing this, right, this could have easily been a very strong indication that price action could reverse. And it is in scenarios like this where trade management can play a big role, because price action could have easily traded higher. But then we only have an initial bullish reaction before price action then rolls over. So as price action rolls over and as it breaks and closes below this particular low, you can be a bit more aggressive, and you can then go ahead and you can trail your stop down towards this low in here, now bringing in that second trade management technique, having already secured some profits in here by taking off partials. So as you guys can see, a couple of different ways in which these trade management techniques can be applied both individually as well as in combination to give you a tailor-made approach to managing a trade. Now, if you guys enjoyed this video, please make sure that you do give it a like, subscribe to the channel so you don't miss out on any future content. As always, I appreciate you guys so much for watching, and I'll see you in the next one.